You could call two insurance companies today, same car, same house, same coverage, and get two completely different prices. One comes back at $1,800 a year, the other comes back at $2,900. Same you, same address, same everything you can see, and nobody explains why. Most people assume insurance pricing is just some number a company makes up, or that one company is greedy and the other isn't, but that's not how it works. There is a math problem running behind every quote you get, and once you understand how that math works, you stop being confused by it. So let's break it down. My name is Jim Eddington, and I run an independent insurance agency called Western Pacific Insurance. We write home, auto, business, and life insurance in multiple states, and because we work with a lot of different carriers, we see the pricing differences firsthand every single day. Two carriers looking at the same person, same property, and landing in completely different places. That's actually one of the reasons we exist, to help people navigate that. One of the biggest surprises for most people is that your credit affects your insurance price, not your credit score exactly. Carriers use something called a credit-based insurance score. It's built from your credit report, but it's weighed differently than a FICO score. It looks at things like how long you've had credit, whether you carry balances, whether you've had collections, and it uses that information to predict how likely you are to file a claim. Now, I know that bothers people. A lot of folks feel like their credit history has nothing to do whether a tree falls on their roof, and I get it, but carriers have decades of actuarial data showing a strong correlation between credit health and claims frequency. People with stronger credit-based insurance scores tend to file fewer claims. That's the rationale behind it, and it's why most states still allow carriers to use it. Some states do restrict it. California, for example, does not allow credit to be used in auto insurance rating. But in most states, your credit-based insurance score is one of the most significant factors in your premium. The practical takeaway here is simple. If you're working on improving your credit for a mortgage or a car loan, that same work is probably helping your insurance pricing too. It's not a separate problem, it's the same financial picture. The next factor is your claims history, and this is one that follows you around whether you stay with the same carrier or not. There's a database called CLUE, the Comprehensive Loss Underwriting Exchange. When you file a claim, it typically gets reported to CLUE. When you apply for new insurance, the carrier pulls your CLUE report and sees your claims history, what happened, when it happened, and how much was paid out. And here's the part people don't expect. It's not just claims you filed on your current policy. If you filed a homeowner's claim 5 years ago with a completely different carrier and then switched, the new carrier still sees it. CLUE follows you, not your policy. There's also a version for auto claims. Same idea, your accident and claims history is visible to every carrier, usually going back 5 to 7 years. The reason this matters is that claims frequency is one of the strongest predictors carriers have. Someone with 2 claims in 3 years is statistically more likely to file a third than someone with 0 claims in the same window. Fair or not, that's how the math works. This is also why filing small claims can cost you more in the long run than paying out of pocket. If you've got a $1,200 loss and a $1,000 deductible, that $200 check from your carrier might not be worth the CLUE entry. The exact impact varies by carrier and state, but it's a conversation worth having with your agent before you file. Your zip code is doing more work in your insurance quote than most people realize. Carriers divide the country into rating territories, and each territory has its own risk profile. They're looking at things like how often claims are filed in your area, what types of claims are most common, local weather patterns, theft rates, fire response times, and even how close you are to a fire hydrant or a fire station. Two people with the same car, the same driving record, the same credit, one lives in a quiet suburb and the other lives in a dense urban core, and their auto premiums can be hundreds of dollars apart. The person in the city is statistically more likely to have a theft, a collision, or an uninsured motorist claim. That's territory rating. On the homeowner side, it gets even more specific. Carriers look at wildfire risks, hail frequency, proximity to the coast, flood zone designations, and the claims history for your neighborhood. In parts of Nevada and Arizona, distance to a fire station is a major factor. In parts of California, wildfire exposure has completely reshaped what carriers are willing to write and at what price. You can't really change your territory, but understanding how it works explains why your neighbor across town might be paying a different rate for the same coverage from the same carrier. You can't really change your territory, but understanding how it works explains why your neighbor across town might be paying a different rate for the same coverage from the same carrier. When you're insuring a home, the carrier is looking at the property itself, not just where it is. Age of the roof, type of construction, square footage, whether the plumbing and electrical have been updated, whether you have a pool, a trampoline, or a wood-burning stove. All of it factors in. Roof age is a big one. A 20-year-old roof on a home in a hail-prone area is going to cost more to insure than a brand new roof. Some carriers won't write the policy at all past a certain roof age. That's not because they're being difficult, it's because the actuarial data tells them that older roofs generate more claims. On the auto side, it's your vehicle's make, model, and year, but not for the reason most people think. Carriers are not just looking at the sticker price. They're looking at how expensive the car is to repair, how often that model is involved in accidents, how often it gets stolen, and how it performs in crash tests. I spent years in collision repair before I got into insurance. I had adjusters in my shop every single day, and what you learn in that business is that two cars can cost the same brand new, but one of them is dramatically more expensive to fix. Specialized parts, limited availability, labor-intensive repairs, all of that feeds back into the insurance pricing. Carriers have enormous amounts of repair cost data on the vehicles they insure, and they use it. That's why a car that seems like it should be cheap to insure sometimes isn't. It's not the purchase price that drives it, it's the repair cost, theft rate, and the claims history on that model. Your age, your driving experience, and your marital status all play into your auto insurance rate. And I know some of this feels arbitrary, but again, it comes back to actuarial data. Young drivers pay more because they're statistically more likely to be involved in an accident. That's not a stereotype. It's what the claims data consistently shows. As you build a longer driving history without incidents, your rate comes down. And back to marital status, married drivers tend to pay less. The data shows that married drivers on average file fewer claims. There are a lot of theories about why: lifestyle stability, fewer miles driven, risk tolerance, but carriers don't care about the why. They care about the correlation. And your gender can be a factor in some states while others restrict or prohibit it. California doesn't allow gender in auto rating, for example. Where it is allowed, carriers use it because the loss data supports it. You don't have to like that system for it to be real, but it does mean the system is grouping people by measurable risk factors and pricing accordingly. That's what actuarial science is. It's math applied to large populations to predict outcomes. This next topic is one of the main areas where you have direct control. Everything we've talked about so far: credit, claims history, location, vehicle, age, those are inputs you can't change on the spot. But your coverage selections and your deductible are levers you can pull. A higher deductible means you're taking on more of the risk yourself. In exchange, the carrier charges you less in premium. A lower deductible means the carrier picks up more of the smaller losses, and they charge you more for that. The key here is to match your deductible to what you actually can afford out of pocket. Don't pick a $2,500 deductible just because it gives you the cheapest premium if you don't have $2,500 sitting in an emergency fund. That's a bad trade. Coverage limits matter too. Carrying minimum liability on your auto policy is cheap, but it leaves you exposed. If you cause an accident that exceeds your limits, everything above that limit comes from you. Higher limits cost more, but the jump in premium is usually a lot smaller than people expect. This is where working with an agent makes a real difference. We can show you exactly what changes when you adjust your deductible or your limits, and we can help you find the sweet spot where you're properly covered without paying for things you don't need. So now you know what's actually behind the price. It's not random. It's not a number someone made up. It's a combination of credit, claims history, where you live, what you're insuring, who you are, and the coverage decisions you make. Different carriers weigh these factors differently, and that's exactly why two quotes for the same person come back at different prices. Understanding how it works puts you in a better position to make smart decisions, and if you want someone to walk you through your specific situation, we're happy to do that. We're Western Pacific Insurance. We write home, auto, and business coverage in Nevada, Arizona, Utah, and California, and life insurance in nearly every state. There's a link below where you can get a quote, and we'll take a look at everything together. Thanks for watching.